Imagine waking up one morning to discover that while the world was focused on headline news and political bickering, a quiet financial earthquake had remapped global markets. A shift of $4 trillion almost overnight, not through hype or speculation, but through structural moves in capital flows, asset allocation, and strategic positioning that have left economists, traders, and central banks around the world scrambling to understand what just happened. What if I told you this isn't a fiction or a what-if scenario? It's unfolding right now. And if you're invested in stocks, bonds, precious metals, commodities, or even your retirement fund, the consequences are already moving beneath the surface. When a number as large as $4 trillion gets reallocated, that's more than the GDP of countries like Canada, Brazil, or South Korea. Something fundamental is happening in the global financial system, and the ripples reach every corner of the world. Whether you're a seasoned investor or someone who checks your portfolio once a month, the question isn't just what happened. It's why did it happen? And what does it mean for your financial future? To grasp the enormity of this shift, let's take a step back and look at the backdrop against which it occurred. For decades, the United States dollar reigned as the undisputed monarch of global finance. Treasury bonds were the ultimate safe asset, a place where central banks and global investors parked capital in times of uncertainty. The total stock of U.S. Treasury securities runs into tens of trillions of dollars, and the daily trading volume in this market can exceed $1 trillion. But over the last few years, cracks have appeared in that narrative. Central banks, especially in Asia, have diversified their holdings, and there has been a gradual but unmistakable shift away from dollar-centric portfolios. Meanwhile, China's financial apparatus, long criticized for opacity, has been quietly evolving, expanding its banking sector into the largest in the world with total assets nearing $65 trillion. And maintaining its position as the country with the highest foreign exchange reserves globally, even as those reserves fluctuate around $3.3 trillion. These numbers may seem abstract until you realize they represent real buying power, real influence over currency markets, and very real levers of economic power. But the story doesn't stop with reserves. Historic context matters here because China's financial evolution didn't happen overnight. In the early 2000s, China's meteoric export growth fueled an accumulation of foreign exchange reserves, largely held in US dollars. At its peak a decade ago, China's reserves approached nearly $4 trillion, making it the largest holder of foreign currency reserves on the planet. For years, this stockpile was considered a backstop, a cushion against currency volatility, and a foundation that supported China's enormous trade surplus. But over time, Chinese policymakers and sovereign wealth managers began to rethink the role of those reserves. Holding vast amounts of US dollars in treasury bonds and cash equivalents has a cost: low yields in an era of rising rates in the West, and exposure to a currency whose future position as global reserve may no longer be guaranteed. So instead of simply holding dollars where they earned minimal interest, investment strategies began to shift toward more diversified and often more strategic asset classes. At the same time, China's domestic markets, particularly its equity and bond markets, experienced rallying momentum. At one point, stock markets across Shanghai, Shenzhen, and Hong Kong saw a combined valuation increase of around $4 trillion, driven by a mix of stimulus expectations, liquidity support, and renewed investor confidence. That's a staggering figure. Imagine an amount equivalent to the combined market value of major European indices moving in sync. Much of this capital didn't come from foreign investors initially. It was fueled by domestic institutional shifts, policy bank flows, and wealth management products offered by major banks that encouraged reallocations from traditional savings into higher-yielding financial instruments. As a result, sectors tied to technology, infrastructure, and consumer demand surged, even as global markets elsewhere were grappling with inflation fears, rate hikes, and geopolitical uncertainty. Here's why this matters outside China's borders. Money doesn't sit still. Capital seeks returns, safety, predictability, and opportunity. When a colossal institutional player like China reallocates funds, whether from foreign reserves toward domestic investment or toward strategic global assets like commodities and rare earths, global supply and demand for those assets changes. Prices adjust, liquidity shifts, and currencies move. In economics, the term portfolio rebalancing refers to how large institutions shuffle assets to maintain target risk levels or return expectations. But when we're talking about trillions of dollars worth of rebalancing, that's not a minor portfolio tweak. That's a tectonic movement with global consequences. Consider how this ripples into precious metals. Gold has long been viewed as a hedge against currency debasement and inflation. When central banks diversify into gold holdings, it can push prices higher. Silver, sometimes called poor man's gold, behaves similarly but has unique industrial demand drivers tied to technology and manufacturing. If a major national player shifts capital into these metals, even subtly, it affects global sentiment. Suddenly, traders aren't just reacting to inflation data or U.S. economic headlines, they're watching foreign reserve flows and sovereign wealth fund behavior. This is why precious metals terminology like spot price, current market price for immediate delivery, and contango, when future prices are higher than spot, matter. They are the language through which global markets digest large flows of capital and the expectations they create. Now, you might be asking, but did China really move $4 trillion all at once? The nuance is that this isn't necessarily one transaction logged on a ticker tape at 10 a.m. It's a strategic shift over months and years, seen in the reallocation of foreign reserves, changing investment portfolios, and targeted domestic market interventions that cumulatively total around that figure. Think of it like an iceberg. You only see a bit of it above water. Stock market rallies, currency fluctuations, commodity price swings. But beneath the surface, massive capital flows are reshaping the balance. And just like an iceberg can redirect a ship with unseen force, so too can these financial movements redirect global markets. But here's the part that often surprises even seasoned investors. While these shifts have enormous effects on markets, they don't always show up in the headlines the way interest rate changes or earnings reports do. That's because most media coverage is short-term by nature, focused on daily price moves or political comments, and misses the structural trends happening over quarters and years. Yet it's precisely these structural shifts, this reallocation of trillions, that set the stage for multi-year trends, changing dollar demand, new rate finance mechanisms, evolving reserve currency dynamics, and redefined risk relationships between East and West. By understanding these dynamics, how reserves, sovereign funds, domestic market rallies, and global capital flows interplay, you begin to see why the phrase, "while America slept," isn't hyperbole. It's a metaphor for how strategic long-term financial behavior can reshape global markets while attention is fixated on short-term noise. So as global investors watched quarterly earnings and Wall Street pundits debated the next Fed move, a different narrative was unfolding. One where capital quietly migrated across asset classes, across borders, and into strategic investments that position China, and anyone paying attention, for a very different financial landscape. And this is just the beginning of the story, because what comes next is how these shifts interact with the U.S. financial system, global reserve currency dynamics, and the real-world consequences for everyday investors, retirees, and ordinary savers. Momentum is exactly what drives markets, whether you're talking about equities, bonds, or commodities. And in the case of China's $4 trillion reallocation, the momentum isn't just a number. It's a wave of influence that impacts liquidity, interest rates, currency valuations, and investor behavior across the globe. Imagine a massive river flowing silently beneath a frozen surface. What appears calm on top conceals immense power underneath, shaping every tributary it touches. That's what happened while America was focused on everyday economic chatter. The quiet, methodical rebalancing of capital by China created pressures and opportunities that most investors didn't even notice until markets reacted. One area where this became particularly visible was in the U.S. Treasury market. Long considered the bedrock of global finance, the Treasury market's stability relies heavily on foreign demand, particularly from large holders like China. When a major player subtly shifts holdings, selling long-duration bonds or reallocating toward domestic instruments, yields adjust, prices fluctuate, and the perceived risk-free benchmark for the world changes. This isn't just theory, it's observable in data. Over the past 12 months, foreign holdings of U.S. Treasuries have declined by roughly $400 to $500 billion, with China accounting for a significant portion of that shift. Treasury.gov, these are not small tremors. They are tremors capable of influencing interest rates for mortgages, corporate debt, and student loans in the United States, affecting tens of millions of Americans in ways that feel completely removed from global finance. Meanwhile, the ripple effects extend far beyond bonds. The foreign exchange markets, for instance, are highly sensitive to the interplay between reserve holdings and capital flows. As China diversified away from U.S. dollars, it put subtle pressure on the currency markets, creating a backdrop where the dollar's strength was tempered even as the Federal Reserve pursued aggressive rate hikes. At the same time, emerging markets, heavily reliant on dollar-denominated debt, faced increased volatility. Countries like Brazil, Indonesia, and Turkey saw capital inflows and outflows swing more dramatically than historical norms, which in turn affected interest rates, inflation expectations, and central bank interventions. The net effect? While most Americans are focused on domestic inflation reports, unemployment numbers, or retail sales, a complex game of global chess is unfolding, where every dollar China moves can subtly shift investment decisions across continents. But it doesn't stop there. Commodities, particularly precious metals, have been prime beneficiaries and indicators of these capital movements. Gold, often considered the ultimate hedge, surged in response to perceived structural shifts in U.S.-China financial dynamics. Spot prices, influenced not only by immediate supply and demand but also by expectations of future capital allocation, saw heightened volatility as institutional investors and central banks recalibrated portfolios. Silver, copper, and lithium, metals crucial to industrial and technological applications, experienced correlated movements because China's domestic policies increasingly prioritize strategic resource acquisition and technological self-sufficiency. For example, the price of lithium, vital for electric vehicle batteries, rose sharply as China leveraged its reserves and industrial policy to secure supply chains, demonstrating how capital shifts are intertwined with real-world industrial strategy. The lesson here is simple yet profound. When sovereign wealth moves, it touches not only financial instruments, but entire sectors of the economy, from the price of your car to the availability of electronics. At the heart of this story lies a concept that every investor should understand: the interconnectivity of global capital. China isn't just moving money in isolation, it's doing so in a context where every trade, bond sale, or domestic reinvestment influences asset correlations worldwide. Think of it like a giant spiderweb. Tug one strand in Beijing, and vibrations ripple across New York, London, and Frankfurt. Stock indices, currency pairs, commodity futures, and even cryptocurrencies respond to these subtle signals. Historical examples reinforce this idea. In 2015, when China's equity markets experienced a sudden sell-off, global markets experienced a mini-crash known as Black Monday, with the Dow Jones dropping 1,000 points in a single session, demonstrating the outsized influence of Chinese capital movements. CNBC.com. Fast forward to today, and the $4 trillion reallocation represents a slow-motion, more strategic version of that event. But the principle is the same. Large-scale capital behavior shapes global sentiment, risk appetite, and pricing. Then there's the human dimension. Ordinary investors who are not watching charts or financial bulletins daily. Pension funds, mutual funds, retirement accounts, and ETFs all react to market movements generated by massive reallocations. Even a modest shift in Treasury yields or gold prices can affect the expected returns of long-term investments. For instance, if yields on U.S. Treasuries rise due to reduced foreign demand, the cost of borrowing increases across the economy, influencing mortgage rates, corporate borrowing costs, and consumer credit availability. Similarly, a surge in gold or silver can alter the risk-reward calculus for portfolio managers, prompting them to adjust allocations in equities, bonds, and alternative assets. The result is a cascade effect where China's strategic decisions, executed quietly over months or years, manifest in ways visible to everyday investors as fluctuations in portfolio performance, retirement account growth, or even the interest rates on loans. Another critical layer to understand is policy coordination. China's moves are not random, they're intertwined with domestic and international policy objectives. For example, domestic reforms in China have aimed at stimulating consumption, improving financial system resilience, and promoting high-tech manufacturing. Internationally, capital shifts support trade negotiations, currency stability, and strategic positioning in global supply chains. This dual focus means that capital reallocation serves multiple purposes simultaneously: financial optimization, industrial strategy, and geopolitical influence. For global markets, this creates both opportunities and uncertainties. Investors who can decode the signals by monitoring bond holdings, currency flows, and commodity positions can position themselves advantageously, while those who ignore them risk being blindsided by sudden shifts in valuations. What makes this scenario particularly fascinating is the psychological element. Markets are driven not only by fundamentals, but by perception and expectation. When a player as massive as China signals even subtly that it is diversifying assets, the market interprets this as information about risk, opportunity, and future trends. Traders, analysts, and institutions respond, creating feedback loops that amplify initial movements. For example, when Treasury holdings decrease, market participants anticipate higher yields, which affects everything from stock valuations to consumer loan rates. When gold holdings increase, commodities traders anticipate inflation hedging demand, which can influence not only precious metals but industrial metals as well. This chain reaction demonstrates how a seemingly behind-the-scenes reallocation can have highly visible consequences for anyone engaged with financial markets directly or indirectly, and the cumulative effect of all these factors, bonds, currencies, metals, equities, industrial supply chains, is what truly stunned global markets. Finally, it's important to recognize that this is a story of scale, patience, and strategy. Moving $4 trillion isn't a day trade. It's a carefully orchestrated maneuver involving months of analysis, regulatory approvals, and cross-border coordination. China's approach exemplifies the principle that in financial markets, size and strategy often outweigh speed. By understanding the mechanics, portfolio rebalancing, reserve management, domestic market support, and strategic foreign investment, we can see not just the immediate impact on prices, but the long-term implications for global economic power, currency dynamics, and financial market stability. The momentum generated by this shift sets the stage for the next chapter in the story, where global investors, policymakers, and ordinary citizens alike must navigate the evolving landscape shaped by these unprecedented moves. Influence is the subtle, often invisible force that shapes markets, policies, and economic outcomes around the world, and in the case of China's $4 trillion reallocation, it operates on multiple levels simultaneously: financial, industrial, and geopolitical. When we talk about influence in this context, we're not just referring to stock prices or bond yields. We're talking about the ability of a nation to affect global risk perceptions, capital flows, commodity valuations, and even the strategic decisions of other central banks and sovereign investors. Think of it like a chess game where one player moves several pieces quietly while the opponent focuses on a single visible threat. By the time the opponent realizes the depth of the strategy, the board has already shifted significantly. China's careful, methodical maneuvers in reallocating reserves, adjusting bond portfolios, and strategically investing in domestic and global markets demonstrate a long-term vision, one that anticipates economic cycles, interest rate fluctuations, trade dynamics, and geopolitical considerations, all while ensuring the nation remains resilient and opportunistic. The immediate manifestation of this influence has been visible in global capital markets. Treasury yields, which serve as the foundation for global interest rates, have experienced unusual movements that do not correspond neatly with domestic U.S. policy alone. For example, the 10-year Treasury yield has fluctuated in ways that suggest foreign demand, particularly from large holders like China, is playing an outsized role in price discovery. Simultaneously, equity markets, particularly in sectors closely tied to international trade and industrial supply chains, VE responded to subtle signals from foreign reserve reallocations. Commodities, too, reflect this influence. Gold, silver, copper, lithium, and rare earth elements have all seen volatility that correlates with announcements or observable shifts in Chinese financial flows. Each movement tells a story, revealing how global investors interpret not just current data but anticipated strategic actions by a massive economic player. One of the most fascinating aspects of this influence is how it reshapes perceptions of risk and opportunity. Investors around the world increasingly recognize that traditional assumptions, such as the guaranteed stability of U.S. Treasuries, the passive role of foreign reserves, or the predictability of commodity cycles, are no longer safe. China's strategic capital movements demonstrate that nations can act as both investors and policymakers, blurring the line between market participation and statecraft. This dual role introduces a new layer of complexity. Portfolio managers, hedge funds, and even retail investors must consider not only economic indicators but also the strategic intentions behind sovereign moves. As a result, decision-making in global finance now requires an understanding of political context, international relations, and the interplay between domestic policies and global outcomes. The industrial dimension of China's influence is equally profound. By reallocating capital toward domestic markets, infrastructure, technology, and resource acquisition, China is not only optimizing its financial position but also strengthening its industrial base. This has direct implications for global supply chains, pricing power, and competitive positioning across sectors such as technology, energy, and critical materials. For instance, strategic investments in rare earth metals, essential for electronics and defense applications, enhance China's ability to control supply and influence pricing globally. Similarly, investments in domestic high-tech manufacturing not only yield financial returns but also position the country to dominate sectors that are vital to future economic competitiveness. These moves underscore the fact that influence is not merely financial. It is a combination of strategic economic planning, market participation, and foresight. From a geopolitical perspective, the influence of this capital shift extends even further. By adjusting reserve holdings and reallocating funds strategically, China is subtly challenging the dominance of the US dollar as the global reserve currency, encouraging diversification into other assets such as gold, the euro, and potentially other emerging market currencies. This has long-term implications for global monetary policy, international trade, and even diplomatic relations. Countries that are heavily dependent on dollar-denominated trade and debt are forced to reconsider hedging strategies, reserve management, and economic alliances. In essence, influence here is about where the ability to shape the rules of global engagement, not through confrontation but through strategic financial behavior. Understanding this influence also requires an appreciation of timing and patience. Large-scale reallocations, like the $4 trillion in question, are not executed hastily. They involve careful planning, coordination with domestic and international institutions, regulatory approvals, and risk assessment. This patience allows China to maximize impact while minimizing volatility that could undermine objectives. It's a lesson for all market participants. In a world where speed often dominates headlines, strategy and foresight are equally important. The consequences of such moves may unfold over months or years, and the effects compound as markets adjust, investors reposition, and policies adapt. For individual investors, retirees, and anyone with exposure to global markets, recognizing this influence is crucial. While you might not directly control how trillions of dollars are reallocated, understanding the underlying trends allows you to make informed decisions about asset allocation, risk management, and long-term financial planning. For example, movements in Treasury yields affect mortgage rates and loan costs. Shifts in commodities influence everything from electronics to energy, and changes in currency valuations impact import-export dynamics and purchasing power. By viewing financial markets through the lens of strategic influence, investors can anticipate trends rather than react to them, positioning themselves advantageously for both opportunities and risks. Finally, influence reminds us that global finance is deeply interconnected. No market exists in isolation, and no major move occurs without repercussions. China's strategic reallocation demonstrates how a single actor, through careful planning and execution, can affect global interest rates, commodity prices, currency valuations, and even the strategic behavior of other nations. The broader takeaway is that in today's financial world, understanding influence, its mechanisms, implications, and signals, is essential for anyone who wants to navigate markets successfully, preserve wealth, and seize opportunities as they arise. By following these movements closely, analyzing their underlying causes, and appreciating the interplay of finance, industry, and geopolitics, investors can gain a clearer perspective on the forces shaping the next decade of global markets. The story of China's $4 trillion reallocation is a masterclass in the power of strategic financial influence, demonstrating how long-term planning, careful portfolio management, and a deep understanding of both domestic and international markets can reshape global financial landscapes while most observers remain focused on short-term headlines. From the subtle shifts in U.S. Treasury holdings that influence interest rates, to the impact on commodities like gold, silver, and rare earth metals, to the broader industrial and geopolitical consequences, this move illustrates the interconnectedness of modern markets and the magnitude of sovereign financial power. For investors, policymakers, and ordinary citizens alike, the lesson is clear. Awareness of structural trends and understanding of capital, flows, and attention to strategic influence are more important than ever. While America slept, China quietly shifted trillions and in doing so, reshaped the rules of the global financial game, leaving a roadmap for those who pay attention and a warning for those who don't.